Hi students, welcome to my channel KT's Commerce Classes. Today again accounting ratios for financial statement analysis part 4. Today we will discuss about profitability ratios. A gross profit ratio equals to gross profit divided by net sales into 100. Gross profit equals to net sales minus cost of goods sold. Now what is cost of goods sold? Cost of goods sold equals to opening stock plus purchase minus purchase return plus manufacturing expenses minus closing stock. Now we proceed to net profit ratio equals to net profit divided by net sales into 100. Number C, operating ratio, cost of goods sold plus operating cost divided by net sales into 100. Operating cost include office and administrative expenses plus selling and distribution expenses. Operating cost exclude financial expenses and abnormal losses. Now number D, operating profit ratio equals to operating profit divided by net sales into 100. Operating profit ratio can be also calculated by deducting operating ratio from 100. E, return on investment equals to profit before interest and taxes and divided by capital employed into 100. Now for finding out capital employed, equity share capital plus preference share capital plus reserve and surpluses plus long-term loans and debentures minus fictitious assets. Alternatively, capital employed equals to net fixed assets plus trade investment minus net working capital. Number F, return on net worth equals to profit after tax divided by net worth into 100. What is net worth? Net worth equals to shareholders fund equals to equity share capital plus preference share capital plus reserve and surpluses minus fictitious assets. Earning per share, profit after tax minus pref dividend divided by number of equity shares. Now dividend per share equals to dividend on equity share capital divided by number of shares. Next one, price earning ratio equals to market price of equity share divided by EPS. EPS means earning per share. Now one question has been given. Calculate gross profit ratio, operating profit ratio and net profit ratio from the following information. Opening inventory 16,000 rupees, closing inventory 19,000 rupees, purchase rupees 2,30,000, wages rupees 25,000, office expenses rupees 10,000, selling expenses rupees 8,000, income tax rupees 20,000, profit on sale of fixed assets rupees 2,000 and revenue from operation, that is sales, rupees 3,60,000. First, while doing the problem, we have to find out cost of goods sold to find out gross profit ratio. Cost of goods sold equals to opening inventory plus purchase plus wages minus closing inventory. CGS equals to means cost of goods sold equals to opening inventory given 16,000, purchase given 2,30,000 plus wages given 25,000 minus closing inventory given 19,000. or cost of goods sold equals to 2,52,000 rupees. Now, another formula, sales equals to cost of goods sold plus gross profit. Sales given, revenue from operation, that is sales given 3,60,000. Cost of goods sold we calculated 2,52,000 plus gross profit. Gross profit equals to ₹3,60,000 minus ₹2,52,000, or gross profit equals to ₹1,08,000. Now GP ratio, gross profit ratio, equals to gross profit divided by sales into 100 equals to 1,08,000 divided by sales given 3,60,000 equals to into 100 equals to 30%. Operating ratio equals to CGS, means cost of goods sold plus operating expenses divided by sales into 100. Operating expenses equals to office expenses plus selling expenses. Equals to office expenses given 10,000, selling expenses given 8,000, equals to ₹18,000. Now CGS we got 2,52,000 plus 18,000 divided by 3,60,000 into 100 equals to 2,70,000 divided by 3,60,000 into 100 equals to 75%. Now, number 3, operating profit ratio equals to 100. Previously we discussed, from 100 operating ratio will be deducted, that is operating profit ratio. Equals to 100 minus 75 equals to 25%. So operating profit ratio equals to how much? 25%. Number 4, net profit ratio. Equals to net profit divided by sales into 100. Now, net profit equals to gross profit plus profit on sale of fixed asset minus office expenses minus selling expenses minus income tax equals to 1,08,000 plus profit on sale of fixed asset, that is given 2,000, minus office expenses given 10,000, selling expenses given 8,000, and income tax given 20,000. Result will be rupees 72,000. Equals to 72,000 net profit divided by net sales 3,60,000 into 100 equals to 20%.